The four key FX themes for 2017 that we highlighted at the beginning of the year, monetary policy divergence, Trump reflation expectations, European political uncertainty, and Brexit, will continue to play an important role in shaping our foreign exchange forecasts. In March, the key event on the European political front will be the Dutch elections taking place on the 15th. Currently, Geert Wilders and the Freedom Party are expected to win the largest number of seats in the 150-seat parliament. Crucial for the markets will be how this plays into shaping sentiment in the run-in to the French elections taking place in April and May. If anything, the most recent polls suggest that, in fact, the Freedom Party are beginning to lose some momentum. And that would certainly help to support the euro if realised in the actual election results. Whatever the outcome of the Dutch elections, we still think political uncertainty will weigh on the euro until we get through the French elections in April and May, with confirmation that Marine Le Pen has not become the next French president. While the Dutch elections will be important, we believe the FOMC meeting taking place on the same day, the 15th of March, will be far more important in determining foreign exchange rate movements. Currently, Fed communications have been very, very clear in shaping market expectations towards a 25 basis point rate increase, which we now think is very likely to take place. But importantly, 2017 will not be like 2016. You may recall at the beginning of last year, the message from the FOMC was that they would raise rates on 4 occasions. And of course, they only raised rates once. We believe this year will be very different. The message from the Federal Reserve at the moment is that there will be 3 rate increases, which we think will be met, with the potential for even a 4th rate increase. So the monetary policy divergence trade is not dead. Indeed, looking at our own constructed DXY 2-year swap spread, that index has reached new cyclical highs, suggesting to us further scope for dollar strength going forward from here. Finally, you may have noticed in that chart, the performance of the dollar has lagged the movements in interest rate spreads. We believe a reason for that has been the uncertainty in relation to the policies of President Trump. However, that might be about to change. Firstly, a much more conciliatory address than the markets expected by President Trump to Congress has raised optimism over the reflation policies being implemented more smoothly. Secondly, the successful meeting between Prime Minister Abe of Japan and President Trump has reduced fears over an escalation of trade tensions between the US and Asia. Finally, the visit by Rex Tillerson to Mexico City, where again a more conciliatory tone was used than expected, has reduced fears over an escalation of trade tensions between Mexico and the US. Also, President Trump used the word tweak in relation to changes in the trade relations with Canada, suggesting a far more pragmatic approach to trade policy amongst key trading partners of the US. So all of these factors leave us confident in our dollar bullish forecasts being achieved over the coming months, as the market's focus shifts away from the uncertainties in relation to President Trump and onto the monetary policy of the FOMC. So our 4 key FX themes of 2017 remain crucial in determining the movements in the foreign exchange markets. But our suspicion is that the FOMC monetary policy decision on the 15th of March will be by far the most important.